Hello, everybody. Just gonna do a live stream. I'm trying to record this one, but it seems like I don't know, my thought doesn't flow as well. So I'm just gonna do the live stream here and hopefully it's coherent enough for this one. Before I go any further though, today is Thanksgiving Day. Hopefully you enjoy your family and, enjoy the dinner later on. I have a couple of minutes to kill here. Not gonna be a long one. But anyway, I want to get this video out. So now I was scrolling down, just YouTube in general, and came across this particular video. And this gentleman, I've shown him before, and of course, Moran's friends, community also know who this person is. But it's the same narrative that AMC is the same as GME. He's bashing everybody who promoted AMC on YouTube, and just seems to include Moran's friends in that as well. Now, of course, I agree with everything that he says about AMC point of view, but I disagree the fact that he kind of broad brushed GME with it as well. And of course, I am biased, right? I'm biased because I own GME. I own this for a long term. And, from a perspective, now I got this from his other previous video that he is a trader, meaning that he will buy and sell stock, shortly, swing trade and whatever, to benefit from the price movement of the stock. So from the perspective of a trader versus the perspective of long-term investor, it are different, right? My camp is that I am a long-term investor on any stocks that I own. The reason being is that I have experience being a trader before, and I didn't like it because it's very stressful. If you have the knowledge to come in and out of a stock and know the price movement of things, yeah, go ahead. You could capture that move and, sell at the right time, buy at the right time so that you could profit off of it, right? The reason why I don't like that is because you never know when the stock's gonna drop. And with the price manipulation and, you cannot trade to win if you just trade in and out of the stock. And there's so many benefits into becoming like a long-term investor rather than a short-term and, trader, is the long-term capital gain aspect of things, right? And I brought this point up before, but as a trader, he's not going to understand why people would want to invest in GME. Now, in this particular live stream, even though it's going to be short, I'm not going to read the chat, so I'm sure you guys are going to watch this later on. I apologize for that, but I just want to get this out for the time being. But anyway, so for this one, I want to kind of show you why I have different, different perspective on GME, why I think AMC is different than GME, right? And if you are a Tonko Native fan here, one of his subscriber, I implore you to look into it look into it for yourself, because this gentleman has never shown you the balance sheet of GME, right? And now, why? Because he's a trader. He's not like looking into the company fundamentally. And there's a case that you could say, hey, look, why do I think GME is such a terrible company? Well, because I see the net profit is $100 million, right? You might see that and say, oh yeah, I don't want to touch it with a 10-foot pole. Okay, I agree with you. If you just look in the first glance and you're like, oh, okay, this company is overvalued, severely overvalued. Okay, all right, I could see that, why you come to that conclusion. But if you look within the the time span, if you don't understand what's going on with GME, now I'm not going to focus on AMC because I agree with everything he said about AMC, right? But to paint the broad brush to GME, that's the point that I want to focus on here. And that's why I focus on the balance sheets. And for those of you who doesn't know or are not aware of what's going on with GME, the reason why people like me and many other, small group, I don't know if it's a large group or not, believe in this company for the long term is because we know the value of this company is going to be increasing. Why? Because number one, we believe in Ryan Cohen, the best leadership that we think is going to bring GME to a better, financial standpoint. And he already did it, right? If you look at the year in which he got in, how do I know this? Well, there's a public letter, right? You could go to the SEC website if you don't want to believe it to see when did Ryan Cohen bought in. It's publicly traded company, so it's publicly there. And when he was to become a board of director, right? So he joined the company very shortly. So technically you have a 3-year-old company that has the best leadership, that has the best way to profitability, right? And yes, there's some things to be worked on right now. That it hasn't been net profit yet, right? But it's coming, right? You know, since when a 3-year-old company is going to be massive, right? Now, when I said a 3-year-old company, I'm not saying that, GameStop just IPO 3 years ago. No. My perspective is that they have better leadership 3 years ago, right? When Ryan Cohen got in, clean up the board, clean up the balance sheet, clean up the CEO, and now he's becoming the CEO of the company himself. So he's here for the long term, we know that. And this is why me, as a shareholder of GME, believe that the value comes from the long-term hold of the company. And it's very easy because, Warren Buffett is the investor for the long-term value of his company. And for those of you who think that if you could trade yourself to riches, there's not many that are, great traders out there who could just time the market just right so that you could capture that value. The value comes in when you hold things for the long term. Like if you look at right here, imagine when people are accumulating right here. Imagine when people are accumulating right here, right? This is the GameStop monthly candle right here. Okay. And so, yeah, it's one of those things that you have to understand yourself. But anyway, so let me go back to to what I was going to point out for you in this particular video. As you can see here, we traded down again, 2% or so, whatever. It's like nothing happened in this company, right? Other than good things. But hey, if they want to keep the price down to that point, that's more share for you to accumulate, right? Now, trading 12, I noticed something over here. Hold on. I just noticed it right now. What is this one? Shareholder standing, basic dilution. So it seems like it's coming down slowly. Do you see that? Shareholder basic. Let me see. Basic share outstanding is the total amount of common share held by all of the company shareholder. So it seems like it's coming down over the year, and this is an annual thing, or trailing 12 actually. So what is going on there? Hold on, okay. So it fluctuates from year to year, but if you do a trailing 12 though, it's trailing down. So what does that mean? It means it's a good thing. So less share into the supply or the bucket, the more share price, the value of your share is going to be better because less share to compete for that dollar amount, right? So that's a good thing. Perhaps they are slowly kind of like taking away shares outstanding. Perhaps because the executive has been buying up and locking it up. I'm not sure. I think that's always a good thing when you see the shares. But again, this data is probably a little bit skewed. We don't know. The best thing to know about this type of thing is to look into the actual balance sheet yourself to see, right? And so this is Q2. Oh, and they just announced that the reported date for next quarter is going to be on the 6th of December. So in a couple of days, I'm going to be so excited about this type of things because, again, they're going to try to bring it down as low as possible if we beat estimation again for this particular quarter, it's going to be massive. But hey, I have high hope for GameStop. I might fall flat on my face. Who knows? Third quarter usually is let's see if we have a good gauge of what third quarter is going to be. Last third quarter is this one right here. So we want to beat that, obviously. $5.9 billion, close to $6 billion. Hopefully this particular one is going to come down cost of revenue and higher gross profit, right? We want the margin to go higher. And then operating expenses, we want that to be lower as well. So we will see. I have full confidence in Ryan Cohen and the leadership to kind of bring that to the forefront. Now, last third quarter of last year, we lost about $500 million. So we're not going to come anywhere close to that. If anything, hopefully we're going to break even or even less than that, right? So another $100 million, perhaps we're going to be flat or even a couple $1 million loss again, just like the second quarter of this year. So that's good. That's just my thoughts here. But yeah, so what was I going into? Okay, the reason why I believe in this is because look at the trending, right? And this is a trailing 12 months, you guys. Trailing 12 months financial income. You see the trend is going the right direction here. So we used to lose more money. Now we're losing less money. Okay. And if you look at the cash flow, I think, let's go to the cash flow right here. See, free cash flow. When you have a positive free cash flow, that's always a good thing, right? It means that the day-to-day, if you look at the free cash flow, it's the cash remaining after the company spends on everything required to maintain and grow the business. So when people tell you, oh, it doesn't matter, it's only been 3/4, or whatever. No, it matters. When you are trending in the right direction, it matters immensely. And on top of that, you have people betting against it, meaning that not many people believe in this because they believe in this narrative that it's the meme stock, that it is just like AMC, that it is just another shitty company for, YouTuber to steer you, into the company, right? And you might view this particular video to be that too, but at the very least, look at the number for yourself, and you might come out with a different conclusion other than me, but at the very least, you'll get to look at it for yourself and not letting these people telling you how to feel about a certain company. Anyway, so let me try to end it here. And this point right here. So what you're seeing here is just me kind of copy and paste this sheets right here to show you something very specific here. Now, what I shown was an annual. So I don't have the ability to do a trailing 12-month at the moment because it's just too much. So it's still, a data point that is kind of relative, but it's not as like a comprehensive, but it still will show you the trend of what I'm trying to show you. Okay, let me get to it right here. So over here, you have GameStop earnings throughout the year. This is annual. And so with the annual placement of things here, you see this is the most recent year. The reason why it's not 2023 is because we only have 2 quarters of earnings. We're not, ending the fiscal year of 23 yet, so you wouldn't be able to see it until March of something, right? March of next year. So that's why you only see 22, 21, 2020, and whatnot. So Ryan Cohen right here, this is when he has the most influence. Well, actually, the end of this year, actually. This is the year that he has the most influence. But since he wrote the board of director at the end of this year, November 16 is when he wrote the letter to try to improve the company, right? So this is Ryan Cohen. Let's do green right here. Green right here is Ryan Cohen, and red right here are older leadership, right? Not to say it's good or bad, but it's, if you compare the number, you're gonna see it. So here's what I'm trying to show you. So right here you have goodwill, right? Goodwill value right here. If I'm gonna kind of gonna highlight it here so that you see a little bit better here. So you have goodwill value. Now goodwill value is just a intangible asset of the company that you shouldn't even mention it, right? The reason why it's there, to me, is just to prop up the balance sheets, to tell you that you have actually more than you actually could produce, right? And company does this all the time when you have those type of things, because either they buy the company over its fair value and then they just put the difference onto goodwill, to like this one right here. If you look at the goodwill value, and of course it's only going back to 2013, the highest ones between these time frame is $1.7 billion, right? So when you include goodwill in that, it's an asset of the company, but it's intangible, meaning that you might not be able to get $1.7 billion out of this, whatever they're holding, on the balance sheets, right? It's just an arbitrary value. So that's why it's so dangerous, because when you don't have it, your shareholder equity is going to be diminished, right? So in the past, when Ryan Cohen got in, there's no goodwill value right here. But in the past, they had been propped up, by using this, right? So you could argue that, hey, GameStop was worse off, but they have, positive net earning, right? So that's a plus. However, the actual asset is skewed by that. And the best example for me to show you is the shareholder equity right here. You see this? So let's focus on the fact that if you were to subtract goodwill from shareholder equity right here, you would see that the real shareholder equity back then, again, old leadership, was lower. So right here, I did the subtraction, and this is why you see this number right here. So back in 2013, it's $900 million. Back in 2014, 600, 600, 500, 500, 500, right? And then 900 increase. This is actually like amazing because this is during COVID. So GME at the time, if you just look at the shareholder equity alone, it's $900 million, so close to $1 billion. But if you were to look at the price in 2019, and this is where the price discrepancy comes from. Because people were like, hey, shareholder equity is at least $1 billion. But if you were to do the math here, you could buy the company at somewhere between $200 million to $250 million. How is that possible, right? And this is where the price mismatch comes in. And this is why people think that it's undervalued. So they accumulate as much as they can over here. And then this is where you see of course, what happened thereafter is kind of a perfect storm too. I make a video about that, meaning that you have Elon Musk tweeting about it. You have Ryan Cohen right here jump in, buying more of the stake of the company, becoming the board of director and all that stuff, clean whole bunch of stuff. But throughout all of this, the company is doing better. Why? If you look at the shareholder equity, from the time Ryan Cohen wrote to the board of director right here, got onto the board, was able to raise $1.1 billion in cash by selling shares, and still increase shareholder equity by twice as much as it has ever been without goodwill. And that is the value that you don't see. And to say that, Ryan Cohen is a failure or whatever, it's just far from the truth. And I hope you could see this, right? Within these 3 years, shareholder equity has never been better of the company. If you have better shareholder equity in the company versus market cap of the company, you are finding gold in the miner right here. This is a mine gold. This is a gold mine that people don't understand that it's valuable yet because it's being muddled by these type of people. Okay, by these type of people, by AMC Bigums, by any other YouTuber that this gentleman is mentioning, but also by himself as well, because he believes that a GME is the same as AMC. And that's what the mismatch happened, is that people don't really look into this themselves and they just believe the narrative, right? And this is why you see a lot of news media out there trying to steer you away from this very thing. Just my opinion here, okay? Just my opinion. Every single news outlet out there, they want you to sell this company. See, only one analyst, and we know who they are, is willing to cover GME because they don't even want to mention it. What they want to mention, though, on the news, CNBC or whatever, they want you to feel like AMC is the focal, is the forefront, because AMC, number one, is a terrible company. Number two, it has so much debt to the point where if you look into shareholder equity, it's in the negative. And that's how you know. This is how you know you have a terrible company, right? Because if you do a trailing 12 months right here, shareholder equity, yes, it's improving, but it's not fast enough to save this company from bankruptcy. Just my opinion here. And again, it's Adam Aarons has always done the right thing in the wrong time, the wrong thing at the right time, all the time. But it's not. It's to diminish shareholder equity every single day. And so it's within these 3 years. On the, if you look at the debt here, long-term debt right here, see that the pandemic comes in, but before the pandemic, though, right here, they were $5 billion in debt already, and so they just load on more debt, double the debt, and then still struggling. So you have to understand that this type of debt has a tie to private equity, and this is why even if Adam Aron want to make the company better, which I don't believe so, he cannot do that because he's beholden to the debt collector. Remember, who are you to the debt collector? You are a slave to the debt collector. So if you look at GME, there's no long-term debt to be had, not to talk about. I know people like to conflate the two companies together, and they don't even, hold on one second, where did it go? Long-term debt, right here. So long-term debt for this one is a current liability. Hold on one second. So other long-term liability for $40 million. Again, this is an annual. If you do a trailing 12 months, it's a little bit different. So long-term debt, this is like account payable or whatever. It's not really a debt. If you want to see a better breakdown, you have to go and look into the actual earnings report, right? So the reason why I say there's no debt is because there's no debt. So if you look at this one right here, the long-term debt, this is a liability. Long-term debt, if you look at that right here, $23 million. It used to be what? It used to be 32. So they did bring it down. So let me look at this is July of last year. Okay. So you have July of last year versus July of this year. So they did pay it down. And on top of that, you see this operating lease. This is the number of stores. So it looks like they have increased in rent price, which is kind of normal, right? Because again, inflation's going higher and cost of doing business is going higher for most people. But even with that high cost, leadership was able to decrease the overall SG&A or whatever for GameStop. So if you look at the debt, there's no long-term debt for this company. So I don't know why the narrative is that they're heavily in debt coming from, right? But yeah, I mean, it's in a couple of days or so, we're gonna see the earnings. Again, December 6th for earnings. So, but anyway, I'm sorry if you write anything on the live stream. I'm only doing this because I'm too tired to do the other way, where I might have to edit something. But anyway, so I appreciate all of you. I'm gonna leave this video right now. I hope you learned something valuable here, and if not, hey, come back, maybe you learned something more. So all right, I'm gonna sign out. Thank you so much for watching, and again, happy